What's up everyone, my name is Ali. Welcome back to my world of stocks. So as a lot of you know, I was doing a little bit of like a stock market weekly update series that I was trying to post every weekend, but I wasn't very consistent with it. I've got a lot of things going on in my life right now, and it's been hard to make sure that I'm also doing all the other types of videos that you guys enjoy on the channel, plus also making that stock market update series for every single weekend. It was a little hard to be consistent with it. So just for now, just for a short while, I'm actually going to change it over to a monthly update series instead. So around the beginning of each month, I'm going to do an update video on the stock market and the economy. I'll tell you a little bit more about that in just a second. But rather than posting it every weekend, I'm going to do it once a month. And then in the near future, I'll probably go back to the weekly structure once I get more consistent with it and I'm efficient and I make sure I have enough time to do all my other types of videos plus the weekly update series. So I just want to set kind of a consistent foundation first, do it a monthly, and then I'll probably go back to the weekly. With that said, if you're not familiar with my stock market update series, what I basically do in these videos is I break them down into three parts. So part one, we talk about how the stock market is performing right now. Part two, we talk about any stock market or economic related news that is going on that we need to discuss. And then for part three, we also talk about the individual biggest gainers and losers for individual stocks for a certain time period, which used to be for the past week. Now it's going to be for the past month. So we'll talk about the biggest gainers and losers, some individual stocks, and I'll let you know if anything kind of catches my eye. And so we'll be able to talk about a lot of stuff, and they're pretty fun videos. I honestly enjoy them. But anyway, in this month in particular, we're going to do a little bit of an introductory episode just because, you know, it's like the first time that we're changing it to a monthly setting. So it's going to be heavier on the economy and the stock market at large. I want to talk about where we're at right now, where I see us heading in the near future, going down, going up, what are my predictions for the stock market and the economy. I want to talk about that kind of stuff, throw some numbers at you and some data and some information that I have. And we'll also, of course, talk about the biggest gainers and losers, and we'll talk about some individual stocks in today's video as well. So I've got a lot of fun stuff to run through here. It's going to be a good one in my opinion. But anyway, with that said, I hope you're enjoying the channel. I hope you're excited for this series. Hopefully we can be a little more consistent here around the beginning of each month, do these updates. But with that said, let's not waste any more time, guys. Let's jump straight into this. All right, so starting first here with part one, the market performance, we can see that over the past 3 months, we had the S&P 500 decline in December by over 5%, then post a very strong rebound in January of over 6%, and it actually went a little higher into February as well. So everyone was kind of thinking that it would turn into this like strong bull market from here, but it actually ended up reversing course a bit and falling by over 2% in February, leaving it down now about 2.3% over the past 3 months, although it is still slightly positive for the year at about a 3% gain year to date. So a bit of a mixed bag there in terms of performance overall, and we've been seeing the same thing with a lot of individual stocks as well. The tech-heavy Nasdaq has also seen very similar performance too, but perhaps a little more to the kind of the extreme, since tech stocks tend to be, you know, highly valued and thus a lot more volatile. But we saw it fall almost 9% in December, then soar in January by almost 11%, and then it fell just slightly in February by over 1%, leaving it almost flat in the past 3 months and actually positive by almost 9% year to date. So it's actually seen a pretty nice rebound here so far in 2023. Still, from the top, the S&P 500 is still down 18%, so pretty close to a bear market, while the Nasdaq is down even more, at about a 30% loss so far, and is still well into a bear market, which would be a fall of more than 20%. All right, and turning over here to market news for part two, and also kind of covering where I think the economy and the stock market is headed. Of course, all eyes lately have been on inflation, interest rates, and the last quarter earnings, as well as guidance for the rest of the year. Those are really the things that are kind of moving the market right now. So going through each one of those in order, when looking at inflation first, it's definitely been coming down. We've now gone from a high of more than 9% in June of last year, now down to around 6% in January. And we still haven't received February numbers yet, but those should be coming out real soon. In the meantime, though, inflation continues to be a major concern because it's still well above the target rate of around 2% by the Fed. And you can see that even here at around 6%, we're still among the highest inflation rates in over 4 decades. So it's completely unsustainable here, and the Fed will continue to fight it by raising interest rates. The problem, however, is that, of course, we've now raised rates at one of the sharpest inclines really in history, and we're even approaching the same high rates from right before the Great Recession and financial crisis hit. And of course, the fear is that raising rates too quickly like this will cause the economy to come to a screeching halt because it gets too expensive to borrow money, and thus companies and consumers spend less, which freezes the economy and causes another recession. And that's the fear that we're living through right now, as over 60% of economists surveyed by the Wall Street Journal in January said that a recession is likely to happen this year. And they specifically point to interest rates being the direct cause of it, as businesses and consumers brace for an economic downturn and thus may start spending a lot less money, cutting their budgets, and we're definitely already seeing heavy signs of this. In fact, 332 of the S&P 500 companies talked about inflation and the weakening macroeconomy in their last earnings call, and tons of big tech giants that play huge roles in digital advertising have already started to lay off workers in drove. Amazon, for example, laid off 18,000, Microsoft laid off 10,000, Meta 11,000, Google 12,000, Shopify 10% of their workforce, IBM 4,000, Wayfair 2,000, Salesforce 10%, Twitter about half their workers. In other words, they're making huge budget cuts, and that's because companies are advertising less on their platforms, which directly affects economic growth. So, in my opinion, we're clearly seeing the economy slow down, and that's why the biggest digital advertiser of all in Google saw only the second decline in ad sales in their entire history, which even included YouTube, and that's something you almost never see. Which leads us to Q4 earnings, which, despite being lifted by an explosion in the energy sector of 57% growth because of oil and gas prices surging recently, the S&P 500 still posted a negative quarter of almost 5% EPS declines, which was the first time since 2020, and we all know how bad 2020 was. And it's likely to get even worse from here. In fact, 81 of the largest companies issued negative EPS guidance for the next quarter, while only 24 issued positive guidance. And if you look at FactSet estimates for upcoming quarters, we can see that not only was Q4 a big decline, but Q1 of this year is also set to be even worse of a drop at about 6% decline, and Q2 following with another decline of that as well at a 4% drop. That does, however, bounce back in the second half of the year with about 3% growth expected in Q3 and a very strong 10% growth expected in Q4, with full year estimates still ending in the green at over 2% growth overall, which is why many economists think that this might be more of like a mild, kind of short recession that we can recover from pretty quickly. And that's why there's so much confusion over what the Fed will do over the next year or two. And the debate is of whether we increase rates higher or just keep them elevated for a longer period of time. At the moment, though, most seem to agree that the Fed won't be lowering rates anytime soon, and some are even calling for as much as 6% rates over the next year, which is dramatically higher than around the 4.5% that we're at right now. I don't personally think we'll go as high as 6% though, at least not in the very near term, definitely not this year, in my opinion, because I think the reality that we're in right now is we're going to continue to see supply chains being restored, lockdowns being lifted in China, which is going to continue to increase supply. And meanwhile, you've got these really high interest rates that we've raised at such a sharp rate that is going to really start to slow down the economy and weaken demand. So I think you should see inflation coming down. I don't think the really high interest rates are going to be necessary. Now, I could be wrong about that. It is going a little slower than I anticipated, so it may take some extra time here. So we may have higher interest rates for a longer duration, but at the same time, I think that we could be going into a recession as well. So raising interest rates even higher, I think, wouldn't make sense, especially if we're going into a recession, which we might even already be in the middle of a recession. We're certainly in the middle of an earnings recession at the very least. But even if we do go into a recession, I actually think that it's going to be a lot shorter and milder than people might expect. And more importantly, I think coming out of that recession, we might be setting up here for a perfect bull market situation here, for a huge bull run, because of the different factors that are in play. Not only are we dragging down inflation, which I think will get accelerated even more during a recession, but at the same time, we are loading up on high interest rate ammunition that at any time we can tap into that ammunition, lower interest rates, and send the economy and the stock market skyrocketing. And that's exactly what happened during the Great Recession. You might recall, Great Recession, we had very high interest rates. Then the Great Recession hits, we lowered interest rates down to zero. And what followed? One of the biggest bull market expansions in history. From like 2010 to like 2019, 2020, you could have thrown money at almost any stock out there and you were making huge gains on those stocks. That was like a very large bull market there for that decade. And I think we could be setting up here for a similar situation because of all the ammunition we have with the high interest rates that, you know, if inflation keeps coming down, we might not need those high interest rates. We can lower them and we can set up for a big bull run afterwards. I'm not saying that that's exactly what's going to happen or that it's guaranteed. I know there are different factors in play, and I know that we have to monitor all of this and certain things have to happen and we have to get inflation under control. But I'm just saying that I wouldn't be surprised if something doesn't set up here in a similar fashion. But either way, regardless, who cares? Because on one side, I see the stock market already down a pretty good amount. NASDAQ down over 30%. There are good deals out there in the stock market. If you don't think there's good deals out there, you haven't been looking. There are good stocks that are trading at good valuations right now that are worth picking up for the long term. So even if we don't get a recession, even if this, even if the stock market stays kind of relatively the same, maybe it stays volatile but doesn't crash, doesn't skyrocket, whatever, there are still deals to be had in the market. So I'm still buying stocks for the long term, but if a recession does hit, which everyone is panicking and so scared of, if a recession hits and a stock market crashes, which everyone is so afraid of, that's a buying opportunity, guys. If you're a long-term investor, then you know what's going on here. Everyone is so afraid of high interest rates. If you're that's only short-term traders. If you're a long-term investor, why are you afraid of high interest rates? That's ammunition that you know is in your back pocket that you can pull out. You can pull out that card when you really need it. When the stock market crashes, you pull out that card, lower interest rates, stock market's going to skyrocket. So that's a buying opportunity. So the way I see it, look, I'm buying some stocks right now. I'm not going crazy. I'm putting savings on the side too. I know that it's a horrible economy. I know that the market might crash. So I'm putting savings on the side, but I'm buying stocks. I'm putting some savings on the side. If everything stays the same, fine, no problem. If the market crashes, okay, I'm going in and I'm buying super heavy. I'm buying super heavy if the market crashes. But look, that's just my opinion because I think that we are going to recover off of that. But that's just my opinion. I know everyone has their own thoughts on it. So, do your own research, make your own decisions. But if you want to know my thoughts, that's how I feel about it. By the way, if you want to know when the next Fed meeting is to kind of shed some light on this, how they're feeling about interest rates and the economy, next Fed meeting will be this month here in March, and they'll probably announce another rate hike. So make sure that you're subscribed to the channel. I will cover that in next month's update video as well. Anyway, with that said, guys, we got to finish up the video here, and it is dragging a little long. So we're going to just kind of do a rapid fire of the biggest gainers and losers for the past month. I'll let you know if any stocks kind of catch my eye, and then we'll finish up the video. All right, and starting first here with the gainers, really wasn't anything too exciting this month since the market actually fell in February, but the biggest gainer of all was Oak Street Health at over a 33% climb, thanks to CVS Health acquiring them for almost $10 billion. Oak Street, by the way, is a healthcare company, so it looks like CVS is trying to better compete with rivals like Walgreens, who made similar moves recently, entering the primary care market. I actually talked about Walgreens in my 3 stocks to buy for March video, where I broke down how Walgreens is adding VillageMD clinics into their own retail stores to make their business a lot stickier. So I definitely agree with the move here by CVS, and they've actually made other moves in the past too that have really helped diversify their business even further, like acquiring pharmacy benefits manager Caremark and health insurance giant Aetna. And most recently, they even went after Signify health for home care as well. And yet the stock has actually continued to crash, even falling in February and now being down close to 30% from the top, mostly because of macroeconomic fears and a tough comparison coming out of the pandemic that was boosted by V-shots, for the pepperoni. But in my opinion, the selling does look overdone here, as it has left them with a dirt cheap valuation that is about 50% cheaper than the sector on a forward PE basis, and a pretty good dividend of almost 3% to go along with it. So I might have to start looking closer into CVS myself, even though I already own Walgreens. Moving on though, at the bottom there, you can see also Palo Alto Networks rising about 20% this month, which is one of my favorite cybersecurity stocks in the market. In fact, you might recall that I actually included them in my best AI stocks for 2023 video. However, at that time, it was trading for $146 a share, but today it's trading for close to $200 after skyrocketing by 37% so far this year. So it's not quite as attractive now as it was then, but still a great long-term play on cybersecurity in my opinion. And then just to finish up with the gainers here, scrolling down a little, we also had Fortinet, which is another popular cybersecurity stock, shoot up about 15%. Nvidia soared by a double-digit rate as well, which is a stock that I own myself and is a fantastic play on the future of artificial intelligence, which is why it soared recently, because AI is getting a lot of attention right now after all the ChatGPT stuff that happened. But then also, finally, the last stock here, DraftKings, also rose by a double-digit percent as well. That's an online sports betting stock that I do enjoy tracking, but it's a bit risky to invest in, so I haven't bought any shares. Okay, moving over to the losers though, we got to go a little faster here. Video's getting a little too long, but we had many popular stocks fall this month. Most of them were riskier spec stocks though, like the electric vehicle startup Lucid, falling 23%. Not a big fan myself. I can't really envision them becoming a big enough player in the EV market, but for some reason, it's a really popular spec stock. We also had Plug Power fall over 20%, and that one I actually am interested in looking deeper into, because I can't tell you guys how many times I get comments from viewers asking me to look into that stock. So I'll probably do it for my next stocks my viewers want me to look at series, but they're actually a company that makes hydrogen fuel cell systems that can be used to power all sorts of different things like forklifts, transportation vehicles, aerospace, and even power backups and data centers. And the company, though, is unprofitable, many times even losing just as much money as they do in sales, and that's led to a super volatile stock price that is currently down more than 80% from the top. So it's why so many people have been asking me to give my opinion on it. But at the moment, it's a bit risky, it's a bit speculative, but I think I will have to do a full in-depth review video of them soon, because it is highly requested. Let me know if you guys would want to see that as well. Also on the list though, we had a couple of satellite media companies fall, including Dish Network at over 25%. I don't even know anyone that still uses satellite dishes for TV, but apparently they're still around. And then SiriusXM, who is the satellite radio company, and I don't even know anyone that still uses radio, but they're also still around. And they happen to fall about 18% this month too. Scrolling down the list a little bit, there was also a lot of e-commerce companies falling, mostly because they're coming off of the pandemic where everyone was stuck at home and shopping online. So these companies were growing at huge rates, but now they're having to face that hard comparison, and that's also at a time when the economy is also just kind of in horrible shape. But all of them fell between 15 and 20%, including the online shopping platform provider Shopify, the global marketplace Etsy, where anyone can buy and sell all kinds of custom or even homemade goods. There was Chinese e-commerce giants JD.com and Alibaba, and as well the online pet goods retailer Chewy. Out of all of those though, the only one that I really like is Alibaba, who is currently still down over 70% from the top, and I think is a great long-term play on the future of online shopping in Asia and other parts of the world too. And just to finish up here, scrolling a little further down, a couple more EV stocks fell, including Rivian and NIO, both falling about 15%. I actually do like NIO as a speculative EV play that is currently down almost 90% from the top here, so I'm choosing to buy a little right now myself, myself, and I included it in my 3 stocks for March video as well. All right, guys, so that's going to do it for this month's update. I hope that you enjoyed it. Let me know your thoughts down below on anything that we discussed. I'd love to hear your thoughts. I'll respond to your comments and we'll have some conversations, but I hope you're all doing well, and I will catch you in the next video. Take care, my friends. Bye-bye.